Between 2018 and 2020, the U.S. and China engaged in a widely discussed trade dispute. Tariffs were introduced on hundreds of billions of dollars worth of goods, and both governments exchanged firm statements. Observers noted the actions of the world's two largest economies, with media coverage focusing on the potential for a shift in global economic relations. While policymakers advocated for economic separation and implemented tariffs, major American financial institutions were steadily directing over $1.4 trillion into Chinese assets. Away from the spotlight, Wall Street was investing in Chinese stocks, bonds, and companies, a move that contrasted with the prevailing political narrative. BlackRock, J.P. Morgan, and Goldman Sachs were at the forefront of this significant capital allocation, at the same time that political tensions were at their height. These firms identified opportunities in China's economic growth, choosing to invest despite the broader climate of uncertainty. This situation presented a clear contrast. While Washington imposed penalties on China, Wall Street expanded its financial engagement. It reflected two distinct approaches within the United States. One focused on policy and restriction, the other on investment and global integration. This was not a routine business decision. It was a deliberate strategy, informed by the principles of global finance rather than political considerations. For these financial institutions, the potential of China's market and its rapid development were compelling factors, outweighing concerns about political disagreement. To understand these decisions, it is useful to examine the historical patterns that influence the movement of capital from established economies to emerging ones. Historically, investment has followed opportunity, shifting from mature markets to those with greater growth potential. In this video, we will analyze these dynamics, exploring how capital flows influence the trajectory of nations and why, in many cases, financial decisions can outpace political developments. History shows a four-stage cycle behind the rise and fall of economic powers. First, a nation monopolizes money creation. Think the Dutch guilder, British pound, or US dollar. Next, it expands through debt, funding ambitions by issuing bonds that the world eagerly buys. Over time, debt outpaces growth, forcing the central bank to print more money and eroding the currency's value. As the system weakens, savvy investors quietly move their capital to a rising challenger with stronger fundamentals. This isn't betrayal, it's self-preservation. The cycle repeats. Capital flees the overextended incumbent, fueling the next era's powerhouse. Understanding this cycle explains the silent financial maneuvers that precede major geopolitical shifts. The British Empire's decline is a textbook example. For decades, the pound sterling was the world's reserve currency, giving Britain global financial clout. But after World War I, debt soared as Britain tried to maintain its empire and welfare state. By the 1950s, overextension was obvious. Aging industry, costly military, and mounting debt. The Suez Crisis exposed Britain's dependence on U.S. support, shattering its financial supremacy. Long before the pound's final devaluation, elites had already shifted wealth to New York and the U.S. dollar. The transition was gradual, not panicked. The financial elite moved first, securing their fortunes in the new order. By the time the empire ended, the smart money was already gone. Weimar Germany's collapse was faster and more dramatic. Saddled with war reparations, the government printed money to pay its bills, triggering hyperinflation. The mark became worthless, wiping out ordinary savings and destroying trust in institutions. But Germany's financial elite acted early. They borrowed in marks, bought real assets, and moved wealth abroad into stable currencies. When the crisis peaked, their capital was safe, while the public was left destitute. After stabilization, those who'd moved money abroad returned to buy assets at bargain prices. The lesson in a currency crisis: the informed and connected protect their wealth. The average citizen pays the price. Capital flight isn't just financial, it's a survival strategy. The cycle punishes the unprepared and rewards the alert. The U.S. faced its own version of the economic cycle in the 20th century, a period marked by dramatic shifts in global finance and power. America's rise as an economic superpower set the stage for a new era in monetary history. After World War II, the dollar, backed by gold, became the world's reserve currency, anchoring the international financial system. The Bretton Woods Agreement tied other major currencies to the dollar, and the dollar itself to gold, creating a sense of stability and trust in global markets. But by the 1960s, U.S. deficits ballooned as the government funded the Vietnam War and ambitious social programs with borrowed money. This era saw unprecedented government spending, which began to strain the dollar's credibility. Foreign central banks, wary of America's exorbitant privilege, started demanding gold in exchange for their dollars, draining U.S. gold reserves at an alarming rate. Confidence in the dollar's gold backing began to erode. In 1971, President Nixon made a historic announcement, ending the dollar's convertibility to gold and effectively collapsing the Bretton Woods system. This move shocked the world and marked the beginning of a new, more volatile era in global finance. Savvy investors, sensing trouble ahead, had already diversified into gold, real estate, and stronger foreign currencies, seeking safety from the coming storm. The 1970s brought high inflation and stagnant growth, stagflation, for those who stayed in U.S. assets. Everyday Americans faced rising prices, long gas lines, and economic uncertainty. Those who anticipated the shift managed to preserve their wealth, while others watched their savings erode in real terms, struggling to keep up with the cost of living. The pattern repeated itself. Capital moved quietly and swiftly before the crisis became obvious to the public, as the most informed investors acted early. The lesson is clear: always watch where the smart money goes, because their moves often signal the next big shift in the financial landscape. In today's world, capital moves even faster, often automatically. MSCI, a key index provider, quietly increased China's weight in its emerging markets index during the trade war. This forced trillions in passive funds to buy more Chinese stocks, regardless of political tensions. Each MSCI adjustment triggered a wave of buying, sending American retirement savings into China's markets. The process was technical, not political, but the impact was massive. Index decisions, made in boardrooms, now shape global capital flows more than government policy. Most Americans had no idea their 401ks were increasing exposure to China. The plumbing of finance, not the headlines, drove the real story. Index changes opened the door, but Wall Street's giants kicked it wide open. BlackRock, JP Morgan, and Goldman Sachs aggressively expanded in China, launching new funds and winning unprecedented market access. They marketed China as the next big opportunity, urging clients to look past trade war headlines. Their logic was clear. With U.S. debt rising and growth slowing, China's expanding economy and opening markets offered better prospects. This wasn't a secret, but it wasn't on the evening news either. The language was technical: diversification, alpha, market access, but the message was simple: the future was shifting east. While the public heard about rivalry, Wall Street was betting on China's rise. The smart money was already moving. The surge of capital into China wasn't an accident. It was the cycle in action. By 2018, the U.S. and much of the West were deep into overextension, soaring debt, low growth, and negative real interest rates. Global investors needed returns, but the developed world offered little. Asia, and especially China, was projected to drive future growth. China's high savings, modernizing economy, and opening markets made it the logical destination. For asset managers, moving $1.4 trillion into China was about math, not politics. The trade war was noise. Capital preservation was the imperative. The financial elite followed the historical playbook, diversifying into the rising power. The $1.4 trillion shift to China is a lesson in seeing past political theater to the real drivers of global change. While headlines often focus on diplomatic tensions and trade wars, the true story unfolds quietly in the movement of capital and investment. The U.S. now shows classic signs of overextension, record debt, polarized politics, and risky monetary policy. These vulnerabilities are not just numbers on a chart. They reflect deeper issues that threaten the nation's long-term stability and its ability to project power abroad. Financial institutions are hedging by diversifying into China, signaling a shift in economic power. Major investors and corporations are quietly reallocating resources, preparing for a world where influence is more evenly distributed between East and West. The consequences are profound. As capital flows east, America's global influence is at risk. This isn't just about numbers. It's about the ability to shape global rules, set standards, and maintain leadership in innovation and technology. Ordinary citizens bear the brunt. Unable to move savings as quickly as the elite, they're most exposed to currency debasement and inflation. Everyday families feel the impact through rising prices, shrinking purchasing power, and uncertainty about the future. Understanding this cycle isn't just academic. It's essential for financial literacy. By learning how these shifts work, individuals can better protect their wealth and make informed decisions in a rapidly changing world. It helps us see through the noise and recognize deeper structural forces at work. Instead of being distracted by daily headlines, we can focus on the underlying trends that truly shape our economic future. History doesn't repeat, but it rhymes, and capital flows are the quiet signal of change. By studying past cycles, we gain insight into what might come next and how to prepare for it. For those who listen, the story is clear. The world's financial center is shifting, and the stakes couldn't be higher. The decisions made today will echo for generations, shaping the balance of power for decades to come. The next chapter will be written by those who understand where the money is going and who are willing to adapt to a new global reality. The future belongs to the informed and the prepared.